Hi, folks. Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory, and we thought we'd come to you with a little bit of a market update, let you know what's going on today. It is earnings week, one of our favorite weeks here. Every quarter, this is the week where we get about 45% of the S&P 500 reporting earnings. Obviously, a lot will happen this week in terms of knowing a little bit better where at least the earnings picture is headed. That's one of the two things that the market is really focused on right now. Just for a level, S&P 500 right now is about 3780. That's certainly well off kind of the lows for the year. And for those of you who are thinking about where you were on September 30th, since you got that statement, the S&P 500 is up about 5% in the month of October so far, which is obviously a pretty impressive gain. But it's been a very, very volatile year. So, don't count the eggs until they're hatched, or don't count the chicks until they're hatched. 45%, like I said, 45% of the S&P 500 report this week. So far, we've already got about 20% of the S&P 500 reporting, and earnings have been, I will say, lackluster, but still, right down the center of the fairway in terms of expectations. So EPS growth or earnings growth of about -2%, -1.5%. And revenue growth of about 7.5%. You're certainly starting to see a little bit of the cost inflation impact earnings, but not decrease them markedly. And I would also just note that there are some sector-driven effects in there in terms of which sectors report first in the S&P 500. If you start to adjust out energy and some of the other sectors, you get a picture that's much more in line with analyst expectations. So feel pretty good about where we are from an earnings standpoint. Second thing that the market is obviously focused on is interest rates. We've been focused on interest rates all year, inflation and interest rates. Late last week, we had the Fed come out and basically comment on Friday that they would, that they were considering what to do in December, that they would be a little bit more data dependent based on the data that they're getting now in terms of inflation and wage growth and some of the signs that we've talked about that indicate that you're starting to see some slowing in the economy. And that's important because it's actually brought a little bit of the forward rate down. So expectations are still certainly that the Fed will raise 75 basis points in November. I think that's probably a foregone conclusion at this point. But expectations for December went from a hike of about 75 basis points to, with 100% certainty, to a hike of about 50 basis points, or 0.5% with 50-50 odds. We're starting to see a little bit of moderation, starting to see some more chatter in the marketplace that perhaps we have reached peak inflation, and that as we reach peak inflation, not necessarily that we will see interest rates come down anytime soon, but that, interest rate hikes are front loaded. And the Fed may raise to a point where they feel like they are being restrictive and then leave those restrictive rates in place for a while to let them take effect. Kind of a gradual cooling of the economy as opposed to trying to get it all done in one fell swoop, which the markets have obviously reacted positive to. So that's a relatively positive sign. It indicates it's the primary driver, in my opinion, for why the markets are up as much as they are during the month of October. Would also just note that the quick shift in the Fed's speak and then the reaction of the market to it is indicative of how sensitive the market and the Fed are to evolving economic data. So just something to keep in mind. Everybody likes to get projection curves even 3, 4, 5 months out. That's very difficult to do, given that we don't exactly know where the data is going to come in. And so trying to invest with a 2 or 3 or 4 month time horizon is probably going to be it's always very difficult, but it's going to be particularly difficult here in the next, couple of months as the Fed gets to that pivot point of, stopping the rate increases and we start to see inflation start to moderate. With that, as always, if you have any questions, please feel free to reach out to myself or to your advisor. I hope everybody is having a great day, and I look forward to talking to you again soon.
Thank you for tuning in. And if you're enjoying this content, please don't forget to subscribe and click the bell so you can keep up to date with everything new at RFG. If you want to learn more about who we are and what we do, please visit our website at rfgadvisory.com.